So how to make it happen? What are the actual avenues to access finance? So gone are the days that you have to front up in front of the bank manager and basically plead your case for a mortgage. It's a pretty competitive market, and today banks want your business. Mortgage brokers are just as keen to get your application in front of them as well. So shop around yourself. This is a great way to learn what's available in the market. Visit the banks directly and see what deal you can broker directly, perhaps. This process can take time, and it doesn't necessarily mean that you're going to secure a good deal. Alternatively, you could also use a mortgage broker. So I'm a mortgage broker. I'm an accredited broker through the FBAA, and I guess my job is really to do the legwork for you. Plus, there's a lot to take in and to learn. So this is even more of a reason to use a mortgage broker services. Now, brokers have the ability to access, a pretty wide range of products from multiple lenders. Therefore, they can, really directly help you to select the right product for your specific circumstances, which doesn't necessarily mean that it's going to be the cheapest option as well. Now, a mortgage broker will chase and liaise with the bank. They'll do the grunt administration work, and they'll be paid a commission from the bank for their work and for securing the loan on their behalf. Now, you can access the First Home Buyers Grant. They'll help you with that. They should also help with budgeting and, should possess good knowledge around the options and the products that are going to be available to you. So to get the best out of your mortgage broker, you really need to carefully assess their skills so you can decide what they offer you. Some questions that you should ask and some questions that I will state to my clients if they don't ask me directly is, to let them know how to decide what is best for them. To work out the impact on, your personal debts and how that's going to affect your borrowing capacity. Ask what fees are involved and make sure the fees are disclosed to you as well. It's actually a regulatory requirement that they are disclosed to you. Have a good understanding of the loan features and what they're all about. Get an idea of what information you need to provide in order to get the home loan approved. You should get your mortgage broker to walk you through each of the individual steps so you've got an understanding what is involved and the timelines that are associated. You should also ask whether or not you should fix the rate or not. Ask perhaps if there's any tips that you can share. Ask if they're affiliated with any particular providers, and make sure you get disclosures. Get them to disclose, and they have to disclose what commissions they'll be paid and what fees and charges will be applicable. A credit guide will also need to be supplied as well as a privacy policy. And, if you're uncertain with any of the terms, make sure you get them to explain it until you're 100% certain you understand. Now, there's a lot of people that will shout praise for mortgage brokers. There's a lot of people out there that will criticise mortgage brokers. And it's probably largely centred on the basis that, brokers may not have your best interests in heart. Some believe that their advice can be skewed to the direction of the highest commission, or that they could be affiliated with a particular service provider, or have limited choices, or better still, they have no idea of what they're actually doing. So to ensure that you're acting in the best interest, get those questions answered. Ask for disclosures, do your own research, and remember you don't need to go with the first one that you see. Getting your finance. Look, having a realistic idea of what you can actually afford is a very important first step before you even go searching for property. Now, whether you start by just having a casual look online by using some of the online calculators that I've already showed you, or you actually sit down and consult with a broker or a lender, it's really good to start, and it's also a potential saver of disappointment perhaps later down the track. So an important first step that I recommend everyone actually do is obtain pre-approval for their home loan before they actually go out and become really serious about acquiring their home. So when you're applying for pre-approval, the things that you'll need to show is that you actually have proof of a deposit. You'll have to show proof of your income, and you'll have to also show some of your monthly expenses, your loans, and also the cost of living. Now, the benefit of meeting the basic requirements means that you'll receive the pre-approval for your home. Now, the benefits are that it's going to remain valid for several months. It's going to provide pretty clear guidance on what you can actually afford. It's going to allow you to bid at an auction with confidence as well. It will prove to vendors that are selling their property that you're actually a motivated buyer and you're pretty serious about taking action. And it's going to save a lot of time. As full approval can actually be achieved within well of a week, once pre-approval has actually taken place. Some aspects to consider, though, before you actually obtain pre-approval. The first of which is not actually a guarantee of finance. It's only an indicator that the lender is willing to lend. Lenders will approach pre-approval in a different manner and assess different aspects. Therefore, different lenders could provide widely different outcomes. It also won't help if you apply for pre-approval with multiple lenders. Pre-approval will appear on your credit file, and it's only going to raise questions with the lender once you complete the full assessment if you have multiple pre-approved obtained with different lenders. Now, the property that you intend to buy, it's also still going to be subject to evaluation during their full assessment process. And if the pre-approval does expire, you're going to have to reapply for it. So not all is lost if you're unable to achieve pre-approval. It just might be an indication that your application was just a little bit premature. Maybe the credit rating score came back a little low, or maybe not enough documentation was provided, or perhaps the loan to value ratio was a little bit out. Now, if you don't secure pre-approval, not all is lost. Reassess your financial situation and try and beef up that deposit to minimize debts and perhaps then try again. So what is the actual assessment process? What will a bank actually look at? So what we're going to do is discuss what you need to bring. So in order for the assessment to go through, you're going to need your driver's license, your passport, birth certificate, citizenship, a Medicare card. Basically provide 100 points of identification, and you're also going to need to confirm where you live. You'll also need to confirm your income. This can be done through your pay slips. Generally around about 3 months of continuous pay slips will be required. Bank statements also showing salary deposits could be a good one to provide. Tax returns, employment contracts. Now, if you're self-employed, you need to take at least 1 year's of individual tax return and an ATO assessment, or 1 year's tax return, and your P&L and balance sheet, plus any other income that you have, whether that is shareholder statements or Centrelink statements that confirm your benefits. You'll need to provide proof of address, like I've just stated. You'll need to provide proof of your savings and list any other assets that you do have. Shares as well, they also need to be included if you do own them, or term deposits perhaps. You'll need to also give details of liabilities that you have, and that is required so banks can assess how much you can actually afford to borrow. So bring credit card statements, bank statements, and other documentation to help confirm this. Insurance as well, your contents insurance or any income protection that you do have. The property purchase or the construction contract, they're going to want to run the ruler over that. So banks need to assess, what it is that you're actually buying. So bring the contract of sale or the council-approved building plans. Have a price building contract or a copy of the land transfer title. Provide proof of other assets, of your superannuation and insurance policy details as well. Now that you've got all the documentation together, which is a lot, the banks will start their assessment process. Now, if you want a check sheet on the documentation that will be required, just refer to the Tools and Templates tab where a check sheet is provided. Now, policies between lenders are going to vary differently. But look, each will carefully assess you. The big ticket items, though, that you need to prepare for and that you're going to need to meet as part of that checklist is the bank will really want to assess your ability to repay. So serviceability is a really big factor in a lender's decision-making process. It's basically a judgment call by the bank on whether they feel that you have the ability to make repayments and keep up a reasonable lifestyle without experiencing hardship, particularly if interest rates should rise. Now, your income and outgoing expenses will all be recorded as part of your ability to repay. So the deposit, now that's another important factor. How much are you actually bringing to the table and how does it affect the all-important loan-to-value ratio? This aspect is important as your house will essentially be used as collateral, as in, held as a hostage if you default. Therefore, what's it worth? And, could that debt also be recovered? What's your credit history? Have you missed repayments in the past? Have you defaulted on your loan or, have you collected one too many X's on your credit file? Unfortunately, the skeletons in your closet will catch up with you. So check out your credit report page. You can get a free credit file check through Vita.com. I have a video in my video section which outlines the process that you can do to obtain that document. Check out your credit score and rectify any mistakes that could be on that file. It's very important to do so. Lastly is documentation and evidence of your earnings. Having proof of a savings history and detail on the assets and liabilities will all be needed so the banks can basically feel confident that you meet the necessary lending criteria. Now, if you are self-employed and you're unable to provide all the income information, you could look at obtaining a low doc loan. Now, this product basically allows you to obtain finance with simplified documentation. There could be additional costs, but it could be a way of getting you into your home sooner. Also, within our video series, we also provide further details on low doc loans, and we'll also cover them in a little bit more detail a little later. So what are the avenues to actually access finance, or what are some of the options and things that you can consider? So one of which is borrowing with a significant other or a friend or perhaps a joint venture partner. And absolutely, that's definitely possible. It's important to remember though that you're actually going to be assessed together or as a group, and some conditions perhaps will apply. Your pool deposit and your joint incomes could be the factors that essentially will get you into your home quicker. Now, we're going to discuss this strategy in the last of our presentations, but it's definitely a consideration that you could make. Another factor is, will the bank take my rent history into account to assess my ability to repay a loan? And the answer to that is absolutely yes. Some banks and institutions will take a rental history into account as genuine savings. However, borrowers will still be required to make a minimum deposit of 5% or more. Now, this can come from a gift or a windfall or the sale of an asset like a car, perhaps. However, for a bank to have more confidence, they have to see that it has been genuine savings, that an amount has grown over time by you making a regular contribution to it. So if you've been a solid renter for more than 12 months and you can show a stable history of repayments with regular contributions to savings, it will definitely provide the lender with the confidence in your ability to actually service the loan. Overall, it's a pretty complicated process and different lenders will use different measurements. However, having a stable career and demonstrating a history of savings will build real confidence with the lender. This could ultimately allow you to get your home over the line. So how long will an application process actually take? So obtaining pre-approval can be achieved in around about 48 hours, give or take. Now with pre-approval in place, it could take an additional week or so for unconditional finance to be achieved. If you start sourcing finance after you sign a contract, it will take a lot longer than you would expect or perhaps even like. It can be a pretty nail-biting exercise, particularly if you don't know at what stage the process is up to. So communication is really an important part of the process. Generally allow for 21 days, give or take, depending on how long it actually takes to get the documentation together and approved. Trust me, you'll sweat on it till you get the green light. So what other borrowing options are available? Well, minimum loan repayments will be calculated by working out what needs to be paid in order to reduce your loan to a donor, basically over the life of the loan, whether that be 25 or 30 years. Now, this will vary depending on interest rate movements and whether you make additional repayments. There are a lot of products and options that are available, all with different benefits and features. But what's the right one? Well, it's really just depends on your circumstances. So consult with your broker and make an assessment from there. And remember, the best loan doesn't necessarily mean that it's going to have the cheapest interest rate. Today, interest rates might not mean a lot, but they soon will. These little puppies can have a really big impact on the cost of your overall loan. A 1% movement upwards in rates could literally mean thousands in additional repayments. So let's look at interest rates in detail before discussing the loan options. Interest rates. Look, interest is basically the cost that is incurred for borrowing, and interest rates are really set to achieve monetary policy outcomes. So monetary policy is really a lever that is pulled up and down to help keep the economy in check. So the Reserve Bank of Australia, they meet monthly. They look at a number of different economic measures and they basically decide the cash rate. And the cash rate they decide is going to be right under the current economic circumstances. So this rate is basically the rate of interest that is charged on overnight loans between banks. So the Reserve Bank of Australia, or the RBA, sets the cash rate. Now the cash rate is typically lower than the bank's official rate. Why is that? Well, banks have their own cost of borrowings. It's called the cost of capital, but mainly because they've also got some fat on it and they need to generate a profit for their shareholders. Banks are in the business of making money, so this figure that they have is essentially the interest rate. So what's next? Well, shop around and use a calculator and crunch the numbers. Now, the cheapest rate doesn't automatically mean the cheapest loan. You need to check the fine print, check the fees and charges, and do the sums. This is where the comparison rate comes into account. The comparison rate will actually help identify the true cost of the loan. This actually includes the interest rate as well as the fees and charges reduced into a single percentage. Now the principal is the really large sum that you've actually borrowed and will be paying back. Now, a common loan type will be structured in a principal and interest or a P&I arrangement, meaning repayments will cover interest costs and a reduction on the principal amount. This is what is referred to as the reducing rate. So you have the RBA, which sets the cash rate, which the banks use to set their interest rates, combined with their fees and charges, makes the comparison rate, and the money that you're paying back is the reducing rate of the loan. So interest on your loan is actually calculated on a daily basis. So the sooner you make repayments, the better. Your loan type and the bank itself will determine how often they'll allow repayments. Generally though, always go for weekly or fortnightly repayments over monthly. Weekly or fortnightly repayments will mean that you'll make an additional 4 weeks of payments per annum, which will save you really big bucks over the life of the loan. So what we're going to talk about here is the more common loan products that are available. In our video series, we also go into quite a lot of detail on the various loan products that are available, so there's some good follow-up information there if you wish to check that out. So the first that we're going to talk about is principal and interest, or P&I, and interest-only loans. So principal and interest is probably the most common type of lending product available. Each week, fortnight or month, your repayments will go towards reducing the principal and the interest accrued. Initially, most of your repayments will actually get sucked up by the interest charges, but over time the amount owing will actually decrease. This is why loans take 25 or 30 years to repay. Taking out an interest-only loan means that you're only ever going to be paying the interest, and therefore the principal amount borrowed will not reduce. People who choose this type of loan are normally investors, as the higher interest charge can be offset as a tax deduction. Also, the regular repayment amounts will be considerably less compared to making P&I repayments. Most banks will offer an interest-only period for perhaps a 3 to 5 year period of time. Another very common home loan product is the variable or the fixed rate loan. So variably essentially means that the rate will fluctuate up and down against the cash rate, which is set by the RBA. Now, a standard variable loan can offer you flexibility and additional features. For example, my loan offers me a checkbook. I'm surprised that these things still exist, along with lump sum repayment options as well. Generally though, this type of loan is basic, no bells and whistles type offering. Fixed means that you can actually lock in the rate. And the best reason to choose a fixed rate is because repayments will stay the same for an agreed duration of time. Typically, this provides you with certainty during the period in question. The disadvantage of fixed rates are that the lender may not let you make additional repayments. Now, should the RBA actually drop their cash rate, then unfortunately you won't pick up that benefit. Also, these loans can be harder to get out of early, as penalties are likely to apply. Guarantors. Now, this is basically loan assistance. That's what a guarantor is. So someone, usually a close relative, can act as a guarantor in order to provide additional security for the loan. The guarantor effectively becomes the loan's guarantee, in that if you default, then the guarantor becomes liable for the debt or a proportion of the debt. Once the debt is paid down or the lender places more faith in your ability to actually service the debt by having built up equity, then the guarantor can be released. This works because the bank will effectively consider the equity in the guarantor's asset, which is used as additional security or collateral. The primary security is the home, and the guarantor is effectively acting as a backup. So consider the fact that your LVR is over 80%. If you could access a guarantor, the equity in the additional property will help lower the LVR rate, allowing you to avoid lender's mortgage insurance. Usually guarantors are close family members like your mum or your dad, or both. Some banks will consider a brother or a sister perhaps. Some banks will consider extended family members, and other banks won't even consider a guarantor at all. Some may actually request that the guarantor be listed on the property title, and if you go down this route, it could mean that you'll lose your first home buyer's grant. It's a technicality, but having a person on the title that has bought the property before could rule, that claim out. If it does go pear-shaped, the implication is that the guarantor will be held personally liable for that guarantee amount. And obviously there could be some major ramifications for your future relationship as well. with that loan. So another loan is combination or split loans. And basically these loans include the best elements of variable and fixed rate loans. Under a combo loan, a portion becomes variable and the other is set as a fixed component. Sounds pretty nifty, doesn't it? So you can have the split 60-40 or 50-50. They're generally the most common forms of splits, but you can do it really any number of ways. Now, honeymoon rates, that's another one that has been come up by the banks. And look, essentially you've done the deed, you've signed your life away and you're in bed with the bank, and because this love affair is going so well, the bank will drop their pants and give you a cheaper rate as a way of saying, I love you too. It's nice, but like most relationships, the honeymoon period doesn't last all that long. So generally they'll offer you a discount on the rate for probably about a year or so. Now, a line of credit loan, it's like having a day-to-day transactional mortgage account, in that your deposit or your monthly salary will go into the loan, and you use your credit card for day-to-day purchases. This card then gets transferred to your line of credit within the interest-free period for the card. What this really means, I should say, is that it basically allows you to simply draw down on repayments that you've already made. It's good for people that are perhaps self-employed. A mortgage offset account. Now, this means that the loan account will be linked to a regular savings account where your salary is deposited. While the cash sits in the account, it is offset, so your loan could essentially be minimised or will be minimised by the interest that you're actually paying. Now, interest is calculated on the loan minus the balance of your account, meaning that it's offset. Shared equity. Now, this means that someone else will take a stake in the action, and banks can offer discounted rates on a proportion of the loan value in exchange for a share of the capital appreciation of the property value. Benefits are a lower rate and lower repayments, which is pretty helpful when entering into the market. What's going against it is that someone else has a stake and a say of what goes on with that property. In the past, this was actually a scheme that was offered by the Western Australian government under the First Start Shared Equity Home Loan Scheme. Now, there's a lot of merit in it, and it could be a great way of getting that initial first step onto the housing ladder. There are many more products out there, but as a first home buyer, best advice is probably just to keep it simple. Shop around and make sure you actually understand the contract and the product that you're actually entering into. Now, I have to apologise because this is a terrible looking slide. There's so much information on it, so I have to apologise for that, I beg your pardon. And look, it does serve a purpose though, because I wanted to really illustrate the large number of expenses that are actually associated with purchasing your property. And some of these are actually occurring on a weekly, monthly, or quarterly basis as well. So it's really good to get your head around what costs are actually associated when it comes to buying a house. There's the lending fees to take into consideration, monthly loan services fees. Again, if it's mortgage insurance or lender's mortgage insurance, they're quite steep in terms of repayments. You've got your conveyancing, your search fees, your building and pest reports, your insurance, your moving costs, the additional little extras that you're going to buy, your flat packs that you'll probably pick up from IKEA. There's a series of government charges as well. But the big one that you really need to be mindful of is actually stamp duty. And stamp duty will vary from state to state. So what is stamp duty? Well, stamp duty is basically a tax that is levied by the state in order to transfer the property. I'll pull up this next slide here because it should give you a better indication of what stamp duty concessions are available and also what grants are available from a first home owner's perspective as well. So again, this slide is a little bit busy, so I apologise for that, but it does give a breakdown of what's available. So, in terms of entitlements, obviously the first home buyers grant is available in all states and territories, and concessions for stamp duty is offered within some of the states. So really, to ensure your eligibility, you have to check out firsthome.gov.au along with the latest updates that are going to apply to your state and territory. Now, when Australia introduced the GST, the government thought that they would help chip in for first home buyers. In actual fact, it was probably one of the major catalysts for the start of the housing boom in the early 2000s. Since its introduction, though, the first home buyers scheme has morphed and changed, and now it varies from state to state. Now, to claim the grant, what you'll need to do is 1, be an Australian citizen or hold permanent residency. 2, you're going to need to live in that property for at least 12 months, and you can only claim the grant once and meet the conditions of the purchase value as well. So the grant value will vary from state to state, but at present it looks something like this. In Queensland, you'll get $15,000 on new homes, up to $750,000 in value. New South Wales, it's the same, and those new homes are up to $650K. So that's probably something for the New South Wales government to look at, particularly after the explosion in prices. Now, stamp duty concessions can apply, and the same within Queensland. You can get a stamp duty concession for properties that are under $500,000. You actually won't be paying stamp duty at all. In the ACT, they'll give you $12,500 for a new home, $7,500 down in Tasmania. You get $10,000 in Victoria, and stamp duty concessions will also apply. You get $15K in South Australia. The Northern Territory, they love giving out money. You get $25,000, which is huge, or $12K if you actually buy an established home in an urban area. Now, the WA government, they give you $10K for a new home and $5K for an existing property, again capped at $750,000. So it's really worth picking up this money. In Queensland, for example, if you buy a new established home and you buy that home for perhaps $480,000, you will pick up the $15,000 from the first home owners grant, and you will also receive the stamp duty concession. So, you're saving tens of thousands of dollars there. So it's really worthwhile looking into and investing. But to stay up to date, I strongly encourage you to really check out your relevant state office of revenue. If you go into our directory, you will find a listing for all the relevant sites that you need to refer to, particularly around the homeowners grant as well. So 2 options actually exist in all states when you apply for the first homeowners grant. You can actually lodge the application through an approved agent, being a bank, or some brokers are actually approved as well. Or you can download the application form, you can complete it, and you can lodge it yourself. Remember that you're going to have to show evidence, though, of all your paperwork, as well as your ID, as well as copies of the sales contract or your building contract as well. Finally, we're at the meeting in the matter. We've gone through a huge amount of information today, so apologies for the overload and at times perhaps pretty dry content. It can't be helped. There's really no argument that these are some of the more drier aspects that we're definitely going to go through, but it's of the most particularly and highest importance that you really investigate and carefully manage your money, as it's going to be a really long-term decision and have a huge impact on your life going forward. So when tackling this, you need to actually find your meaning. Why are you doing this? What is the path that you're going to follow? Think about the what and the why. Plus, it's part of your homework. I want to hear from you. I'm going to be reaching out to you via email during the week, so watch out for these mails. And the second part of the homework is that I strongly suggest that you go into the tools and template section, that you do complete your budget and your your debt reduction spreadsheet as well. I'm also going to be offering everyone an opportunity to call and review their budgets one-on-one so we can ascertain what we can do from a borrowing perspective and determine whether obtaining pre-approval is going to be right for you at this point in time. Also, if you would like to book your session, please log into your account and select the booking prompts and follow the tasks from there. But look, that's it. I just want everyone to have a really great week, to really think about why they're doing this and what is motivating them to do this. And more importantly, tackle some of those templates and tools in the necessary sections there and start making a plan. Get out there and do it. Stick to it as well. We'll see you next time.